Thank you. Good morning. Carolyn and I are pleased to be here today to discuss the December issue of our biannual Financial System Review, which was just published this morning. La RSF n'a pas pour objet d'anticiper l'évolution la plus probable du système financier. Elle sert plutôt à mettre en lumière les principales vulnérabilités financières, ainsi que les catalyseurs qui pourraient les transformer en risque pour le système financier. La RSF est un complément essentiel à notre rapport sur la politique monétaire. Ces deux flux d'analyse servent de base à une discussion approfondie sur la politique monétaire à l'intérieur d'un cadre de gestion des risques. Nous examinons les risques liés au système financier séparément de ceux qui entourent la croissance et l'inflation. Mais nous réfléchissons sérieusement aux interactions entre eux. In this FSR, we discuss three important financial system vulnerabilities: high household indebtedness, imbalances in the housing market, and increased investor risk-taking. To some extent, all three are normal side effects of stimulative monetary policy. However, the post-crisis recovery has been frustratingly slow. We've called it serial disappointment. And bond yields and policy interest rates have been unusually low for a long time. So in this context, these financial vulnerabilities have built up over time. Fortunately, Canada's economy is showing the first signs of a broadening recovery. Non-energy exports have been responding to stronger U.S. growth and exchange rate depreciation. Investment spending appears to be picking up, and we've seen pockets of new job creation. Now, this natural rebuilding sequence is key to reducing financial vulnerabilities over time. In particular, our expectation of a soft landing for housing hinges on stronger growth, employment, and incomes. La faiblesse récente des prix du pétrole et d'autres produits de base fait toutefois peser des risques importants sur ces perspectives économiques. Ce choc est particulièrement complexe. Il est susceptible de stimuler la croissance mondiale, mais de modérer l'expansion et l'inflation au Canada, même si les effets devraient être atténués par la baisse du taux de change et la hausse des exportations hors énergie. Dans les mois à venir, nous allons suivre de près les conséquences possibles pour le système financier. Meanwhile, the global financial system is stronger and more resilient, thanks to continued progress on implementing the G20 regulatory framework and the efforts of policymakers and market participants around the world, including Canada. So in light of this continued progress, and taking into account the early signs of stronger exports, investment, and employment in Canada, we judge that the probability of an adverse shock has eased since our June FSR. This mitigates our observation that some financial vulnerabilities appear to be edging higher, leaving our overall assessment of financial stability risk roughly the same as in June. And that's why we continue to believe that the overall balance of risks remains within the zone for which the current stance of monetary policy is appropriate. Now, let me just add a few comments specific to the most important risk discussed in this FSR: the difficulty that highly indebted households would have servicing their debt if they were to face a sharp decline in their incomes or a sharp rise in interest rates. This situation raises the risk that a shock to the economy could trigger a correction in house prices. The probability of this risk materializing is low, but if it did occur, the effect on the economy would be severe. This risk would be greater if house prices were judged to be overvalued relative to fundamentals. Now, bank economists have done some new research on this risk, highlighted in a box in this FSR and in a research paper released today on our website. Although there is considerable uncertainty around this question, various approaches, including our own, suggest that there is some risk that the housing market is overvalued, and our estimates fall in the 10 to 30% range. Nous avons connu des corrections des prix des maisons au début des années 80 et au début des années 90. C'est arrivé après des périodes de surévaluation des prix de même ampleur. Toutefois, ces deux épisodes ont été précédés d'une montée beaucoup plus rapide des prix. En même temps, les attentes d'inflation étaient en hausse. Dans les deux cas, les taux d'intérêt ont augmenté dans le contexte d'une politique monétaire axée sur la maîtrise de l'inflation, et une récession a suivi. So none of those conditions is present today. The rise in house prices has been much more gradual, and in the context of a broadening recovery, the unwinding of household imbalances should be gradual as well. And that is why we continue to expect a soft landing in the housing market. But it is conditional on continued strengthening in the economy. Now let me reiterate the FSR's bottom line. After careful analysis of the latest economic, financial, and regulatory developments at home and abroad, our assessment is that while vulnerabilities associated with household imbalances and housing markets are edging higher, the overall risk to financial stability in Canada is roughly the same as it was at the time of our June FSR. And with that, Carolyn and I would be happy to take your questions.
First question, Nirmala, Wall Street Journal.
Governor, you've long held that this housing imbalances are an issue, and you have an extensive discussion about low rates being the cause of it. And at what point do you say enough is enough? We need to raise rates. This is a problem.
Well, we don't see ourselves as targeting housing markets in any way. In fact, they come as part of this context. Indeed, those kinds of macroprudential issues in that setting, the Bank of Canada sees itself as well back from the front line, indeed the fourth line of defense, if you like, ahead of which we would see prudent behavior on the part of the borrowers and the lenders, supervision by OSFI, and macroprudential adjustments such as we had during the run-up, a number of tweaks to the mortgage finance sandbox. So monetary policy is well back from that precisely because our job is to focus on the inflation outlook and to take into account what those vulnerabilities are as we make those more tactical decisions.
Do you think it is time do you think the situation warrants another round of measures by the government? Mortgage tightening, mortgage insurance tightening?
Well, I would leave that to the government to talk about. Our view is that our forecast for the economy and inflation is such that the soft landing for housing is part of that story. And so, as I said in my opening remarks, they are cross-dependent. We never expected that housing imbalances would simply go away by themselves. What we expected was that it's the strengthening economy, the increases in employment, rising incomes, which would make all of this more normal, if you like, to validate where we are. And so we still believe that that process is in train, and we've had our first encouraging signs that that's true, which is why we've indicated that we think that the probability of an issue in that space has ticked down a little over the past few months.
Greg Quinn, Bloomberg.
Governor, it's clear oil prices are a big concern, and you mentioned it in your interest rate decision, but it didn't become one of the four formal risks in the financial system review today. Can you explain why it's not a risk to the financial system if it's a big economic risk?
Well, at this stage, we do see it as primarily an economic risk, and one that, you know, at the moment, it looks like it would keep us kind of in the zone of our outlook. We haven't done all of the analysis around this because we will do so in our next full forecast, which we published in the NPR in January. But enough to understand that would normally. We know the higher oil price is probably good for the world. Excuse me, I misspoke. The lower oil prices are more likely to boost global growth, and that's a positive thing, both directly and, of course, indirectly for Canada. But that's an offset for us because we are being a net exporter. Our first effect will be a negative one from the oil price shock. We will have some positive effects on consumption and so on, those kinds of things like other economies have. But the net effect for Canada, we suggest, is in the order of 1/3 of a percentage point. But that has to go into the mix with other changes to our outlook, which we haven't redone yet. So I can't give you a full story. But we did note in our press release last week that the stronger third quarter and the revisions that came with it did suggest that the output gap today is a little less than we thought it would be. But that's our starting point. The path of the output gap, and therefore the profile of inflation, will need to be recalculated or re-estimated, taking into account this lower profile for oil prices. And that's a bigger job for January.
Secondly, Governor, your comments earlier this year on unpaid work and young adult Canadians, it created a lot of debate, but it also created some criticism or anger from young people. Do you think you went too far in describing a problem in the labor market?
Well, obviously a lot of people care very deeply about this issue, myself included. And it's not just a Canadian issue. It's one that is shared by most economies, certainly the major economies. In fact, it was the main topic of discussion at this summer's Jackson Hole conference. So there's a lot of analysis going on to understand that better and to see, you know, you need to understand that better to understand how the economy will evolve from here. So what monetary policy can do in this space is to foster the right conditions for what I've called before natural economic growth. That's the self-sustaining type of economic growth, not the induced type. But self-sustaining economic growth that creates new capacity, creates new companies, and thereby creates new employment. And that, in the context of stable inflation, is our goal. And what we are doing is to do everything we can to maximize that opportunity for the economy to do just that. So that's where we sit.
Randall Palmer, Reuters.
Governor, you say in the FSR that the recent fall in commodity prices would not be enough to tip Canada into a severe recession or a sharp correction in house prices. Is there a point at which either the more recent fall since this was calculated in oil prices to a 5-year low, or a further fall in oil prices could in fact tip Canada into a severe recession and a sharp correction in house prices?
Well, there's certainly, in theory, that's exactly what that would look like. You have, if commodity price, it depends. I should back it up one chapter. It does depend on what is the underlying cause of the decline in oil and commodity prices. Our analysis most recently was a big part of it was because of supply reasons, and that perhaps it's been catalyzed by a bit of a downgrade in another chapter in the Serial Disappointment series. The world is a little bit underperforming relative to what people expected, say 6 or 8 months ago. And as that downgrade happened and we got into sort of October there, that fed into the excess supply in the oil market and gave us this rundown. So if it were all because of demand, that would be more of a concern, right? It would mean because the world economy is actually becoming a lot slower. But our reading right now is that it really isn't. There are some, the data never go in a straight line. on this, and so the world economy continues to gather its strength, but more like the tide coming in. It's hard to see at every minute, but eventually it starts to be clear that the cumulative effect is a positive one. So we still have that view, and in that context, with this decline in energy pricing, it's more or less purely a price effect, and so you have to figure out how that works through the economy. And as I said, if it's on the order of a third of a percentage point, we were predicting growth somewhere in the 2 to 2.5% range, and so it's sort of still in that kind of zone. And so the path that you lay out may not be all that different. It's going to be different, but it's not going to be, as you suggest, a major recession or something like that. But of course, it has the potential, if it got really large, to have more of those risks associated with it. But we aren't anything in that ballpark yet.
I'm just thinking that if you estimate the effect so far of the fall in oil prices has been a third of a point, third of a percentage point, and prices have fallen, let's say, 1/3, does that mean that, sort of extrapolating, that if prices went down to $10 a barrel, that it would only be about a whole percentage point, another 2/3?
Well, yeah, it's a good question. It's probably not so linear as that. Okay, there'd be points where there would be a much more substantial shift in behavior, both of investment in Canada and the income effects would become very noticeable. So just by point of reference, we know the run-up in oil prices from the mid-20s to around $100, give or take, had about a 25% increase in our terms of trade. That's roughly around the 10-year rise in oil prices, give or take. And that 25% rise in Canada's terms of trade boosted total income in Canada by around 7 percentage points. And that doesn't stop because it stops rising. It's every day you're getting that extra income by selling oil to the rest of the world, and not just oil, but other commodities. And so now that we've gone from $100, and we've retraced perhaps, like you say, around a third of that rise, maybe a little bit more. And so on the order of a couple of percentage points, let's say, of income would be the ultimate effect of that income for the whole country. And we know it's concentrated in oil-producing sectors or regions, but what happens is those folks then spend the money, and it actually affects income across the entire country. So that's why we say it's net beneficial when it rises, even though it causes these strains. But the reverse is also true. It hurts because it reduces income for Canada as a whole.
Richard Madden, CTV.
Hi, Governor. I know you outlined it a little in your report, but some homeowners are going to find this alarming, particularly those that are thinking of selling, that some homes could be overvalued by 30%. So I'm wondering if you can outline what regions in this country you see this overvaluation unfolding, and what impact do you think your comments will have in the real estate market as we look ahead to the spring market?
Well, first, what we've done is we've published a paper today which adds to this, to our insight into this situation. It's not the definitive point to put a pin in a number, and so I would frankly resist this citing of the 30% or 20% or any of these. What it does, there are a number of different methodologies that economists can use to assess this. And they kind of range in that sort of 10 to 30% range. And so it's, in a way, reassuring that we take this model, which is not just about Canada, but actually analyzes over 40 housing correction cycles around the world. So it gets a lot more information into that question. Housing markets, of course, differ from place to place, but the fundamentals and how they drive are not that different. People behave similarly in other housing markets. So that gives us a lot richer kind of insight into this. So the good news is that model, simple as it is, kind of gives you that same 10 to 30% kind of range of possible overvaluation. And so that kind of validates it, and because it cross-validates other things. But it also tells you some other things, like according to that, we've been overvalued by at least 10% and probably more, actually, for several years. So it's not as though we became overvalued yesterday by some number. It's actually been building up for a really long time. And as I said in my opening remarks, when you contrast that to 81, 82, and 91, thereabouts, there's a really big difference if you look at the charts in that paper. That in preceding those corrections in housing markets, we had a very sharp run-up in prices. And it was in the context of building inflation pressures overall. So often rising house prices are a symptom of exactly that. It's just part of the process. And so interest rates were rising, and of course we know what happened, that things slowed down, and there was a recession in both cases. So the housing correction then went into the recession period, so there were high unemployment was rising and so on. So you have all those ingredients, none of which are present today. And so the model can't do everything. It doesn't, for example, identify markets that have restricted landmass. So, for example, Hong Kong or Vancouver, where there's only so much space. So it can only do so much for us, but it does give us a little bit of insight. And the last thing I guess I'll mention is that because it's a very high-tech thing, it's a very sophisticated model, what we call a logit model. And what it tells you is it also calculates a probability that there's a housing correction. And that probability is actually really low compared to those other historical episodes. And actually it looks like it's falling. But I think the more important thing for us is that the model is about the past and now, and the question is what's happening next? Well, we believe the economy is gathering strength. It's beginning to rebuild itself. It's going to create new jobs, and income is going to go up, and all those kind of metrics are going to start to look better. And so the sustainability of the housing market will be buttressed by that. So that's our main source of reassurance from this.
You used the word ingredients, so I'm just going to steal that for a moment, because you've got some ingredients. So you have continued low oil prices, and this overvalued housing market. Yeah. If these two issues persist, in your mind, how dangerous is this to the health of the economy, and how could it throw off your forecast?
Well, we've highlighted that as a risk that remains to be worked through. At this stage, it's all happened quite quickly. I don't want to speculate on whether it's going to last long or not. But what we'd expect is that its effects would not be overnight, that, as we described, that the economic, according to our economic models, those effects of movements in oil prices take time to work their way through the system. But it's something that we have to be mindful of. The issue that you're raising is a valid one, but I can't hazard a guess right now on when it becomes that significant and whether it has those effects. Carolyn, do you want to add anything?
I would say that in addition to that, it's not just a Canada story, and so when you think about from a financial stability point of view and an economic point of view, there are some other jurisdictions who were heavily dependent on commodities and oil in particular that may come under financial stress that comes from the fact that they have a lot of foreign debt, from the fact that their fiscal situation is highly reliant on oil revenues. And in that regard, being exposed to rapid depreciation, their exchange rates and capital outflows can cause, in and of itself, some financial stress. And of course, we could think of some of those countries, Russia, for example, some Latin American countries. And so that's also another aspect that we're keeping our eye on.
Gordon Esfield, Financial Post.
Thank you. This question, I have a couple questions, but either one of you can answer. It's fine with me. We did mention the 1/3% being knocked off of GDP growth. What time frame are you looking at? I just want to clarify that.
Well, like I said, Gord, we haven't redone the forecast on this, but that would be a 2015 kind of number. And if the oil prices persisted, you'd expect it to kind of continue to edge in there. But I think that to get into dynamics, we'll have to wait until we've actually run the models. That'll be in January.
So again, using the term tipping point,
Yeah.
when does 1/3% be overtaken by 1/5 of a percent or 75%?
Right.
When is that a tipping point where something else raises your concerns?
Well, today we're talking about financial stability, which is it's not the economy is one of the inputs into that. We'd be looking at questions like, is our financial system well diversified? As lenders, the large banks for sure are, and diversified and very profitable, and well capitalized and so on. So there's lots of cushion in there if some of the loans that they've made in that space were shaky, let's say, at a lower oil price. So that's where a financial stability issue would come into play. The second layer would be if the economy slowed enough that it caused unemployment to stop declining or to begin to back up. Then there might be some issues around people servicing their debts, and the housing question would become more alive, right? So, but right now, as I said, in that sort of 1/3 of a percentage point range, it's probably not enough to derail all of this. But I caution you that we haven't done all the math around it. So, because if we look back to what we said last week, was about the output gap being a little smaller. So behind that is the level of GDP is higher than we thought before because of the revisions and because of the third quarter. So we have to, and the U.S. economy seems to be getting a little bit more momentum than what we had built in. So those things are kind of offsets in that. Plus the Canadian dollar has been going down with the oil price, which is more or less what you'd expect. So there too is another offset to the effects. And so all those kinds of offsets have to be figured in and in effect cushion it. Even things like the tax changes at the federal level, the new infrastructure spending, those are things that they're little decimal points in that picture, but they count when you're talking about 1/3 of a point. So all those things have to go into the mix, and we'll have to see. And it's also the dynamics of what happens, not just the level or the starting point, which matters. But one thing's for sure, that lower oil prices like this are going to push our inflation rate down. I mean, price of gas is it's like a Christmas gift right now.
Any other questions? Y a-t-il d'autres questions? Richard?
Just to get back, because on my first question, when I asked you about whether your report on the housing market, what impact do you think this will have on the real estate market?
Well, Carolyn, you want to take that?
I think the intent of the report is to just provide information that gives more texture to the comments that we've made about, first, just signs of overheating in housing, and give an example of some research that we've done on how we came to that conclusion. It's, of course, one piece of research among many, and the intent wasn't to have any particular input on particular markets.
And just there are those who would suggest that the overvaluation of the housing market has been caused by years of low interest rates. So how much of this would you think falls on your shoulder? How much of the blame falls on the bank's shoulders?
Well, as I said in my opening remarks, these things that we analyze, these financial stability risks, many of them are the natural consequence of an extended period of easy monetary conditions. So when you have a typical business cycle and you cut interest rates to cushion it, you cut interest rates to encourage people to spend more, borrow and spend. They buy houses or cars or what have you, and so that's exactly the intent. And so by having lower interest rates, you're convincing people now's the time as opposed to waiting. And so that's all right because 9 months or 12 months later, things are going back to normal, and you never really talk about the financial stability risks. But when it starts to stretch into years, those decisions keep happening. And what has happened, indeed, is that we've had this serial disappointment in the world economy. So interest rates that you borrow at, mortgage rates linked to the global bond market, have continued to drift down. So adding to that, that's where we get the edging higher kind of notion that the fuel continues to be there and actually to be increased. And so in that context, you have to say, yes, that's one of the side effects of low for long, and yes, that's because of monetary policy. But then you'd have to say, but yes, that's because of the situation we face. And the situation we face is where the headwinds have been so strong. You have to, if the growth you see in the U.S. looks pretty good now, you have to say, oh yeah, but that's happening at zero interest rates. What would it be if interest rates were, back to normal? And similarly ourselves. So we have to take into account that we're still pushing against some pretty significant headwinds in the economy, and that is our primary job. Our primary job is to keep pushing on those, ensure that we get that follow through and the job creation, and that inflation then is stable at our target.
Randall?
Just wanted to check on our interpretation of your interest rate statements. In October, you said the risks from, if I'm recalling correctly, the risk from household imbalances were edging higher. December, you said they were significant. So I had interpreted that as, well, they've arrived. They're now bigger than before. You've used the word significant before, though. How should we interpret that language around significant and edging higher?
So this is a good illustration of why parsing is not very profitable, because in our minds they've been significant for a long time, but it's also a side effect of the fact that we really do start with a clean page each time we write one of those press releases. So when we say it's significant, we mean that it's significant, it's important, it's something we've got to keep watching, and so on. But when we went back to the spring and early summer, like say it's spring, I'd better say, winter, spring, we had, of course, fluctuations in the data because of bad weather. And trying to see through those, we reached a judgment that actually it looked like the constructive evolution was in place, that we were actually getting a little bit of cooling in a few places where we were watching for it in the housing market. Well, as we got into the summer, we realized, well, that was, if at most, a temporary thing or a false conclusion. Things seemed to be picking back up again, and in part because we did have another down leg in yields, which kind of added a little more fuel to that. So by the time we got to that press release, we said in the NPR, we said, well, those risks appear to be edging higher. And when we got to 6 weeks later, which was last week, we had no new news on that. We had no evidence that they were edging even higher. So we didn't say that. We said they're significant. They edged higher the last time we were looking at exactly that. And we'd have an opportunity just a week later to tell you a more fulsome story about what our judgments are. Does that help you? So they've been significant for some time, and they still are. Okay. Thank you.
Any other questions? Thank you very much.
Thank you.